Leela Bangalore recently listed. Schloss Bangalore is the name of the company. For the first quarter, the company's seen a healthy revenue growth. EBITDA saw a strong 50% jump. They've repaid 2,300 crores from issue proceeds. To talk about how Q1 went and what's the outlook in this quarter, that is Q2, we have Anurag Bhatnagar, Chief Executive Officer of the company, now joining us. Anurag, good morning. Great to see you once again. And good to be talking now that you are, of course, in the listed arena. So we can talk specific numbers, Anurag. If you can tell us, how was July gone? And at the margin, are things as strong as what we've seen over the last couple of quarters, or is there a bit of slowing?
Hi, Prashant. Great to be here. Thank you for having me. I think before I get to July, let me just give a brief color on the quarter that just went by, which typically is considered a bit of an affected quarter. There were some headwinds, there were some geopolitical tensions, as we all know. Despite all of that, we saw 25% growth in our revenue, a 63% growth in our EBITDA, and almost a 10% margin expansion on the EBITDA. Now, looking at July, our business that we recognize in the luxury segment is very resilient. And we have seen that looking at the macroeconomic indicators, the growing affluence, the consumption for luxury products and services and experiences, and the iconic nature of our hotels, we definitely are looking forward to a great July and as well as this Q2 as well.
So, hi, Mr. Bhatnagar. I'm just looking at some of the internals, and they're looking really good. Your top line is 20% growth. Margins have improved to almost 37%. Your occupancy has also gone up. I think you're at about almost 64% now. How sustainable are some of these metrics? Let's start with the margin itself, because it's looking very, very smart. Operating margin at almost 37%.
So a lot of investment has happened into our properties over the last 5 years. We have invested in CapEx. We invested in green energy. 51% of the total energy in our hotels comes from green energy sources. There is a lot of investment that has gone into asset management practices and revenue management. We have a new website, which is delivering almost 72% growth year on year in terms of both visits as well as in terms of optimization of the revenue. So we definitely believe with all the efforts that we have made and the value drivers that we are instigating in all our hotels, we definitely believe that these margins are very sustainable because we have gotten a robust cost discipline. We have also got synergies within the company and with our promoters to ensure that we get great procurement synergies.
But sir, the thing is that I think when we've spoken to you earlier, you've given a rough guidance of mid-teens EBITDA growth. But your EBITDA this quarter, first quarter itself, has jumped over 50%. And then, like I said, margins at almost 37%. So do you want to revisit that? Can you give us some sense of full year FY26 guidance for EBITDA growth, for margins, and maybe even revenue?
I think our margins, if you look historically, have been extremely high, as you have seen, close to 49, between 49 to 50%. And this is the margin that we are looking at for this quarter and towards the year end as well. And definitely sticking to a mid-teen kind of a EBITDA growth year on year.
50% margin. Okay, got that.
Close to 50%, I would say.
Close to 50% EBITDA margins.
Anurag, what will occupancies be? I think, will they be in this early 60s kind of range?
For the year end, look, this quarter obviously was impacted for a couple of weeks, I would say. But the Leela business is very resilient, as it is in most luxury products and experiences. So we didn't see much of a blip. But we definitely believe that H2 is typically 2x and far more stronger than the typical H1 in terms of financial year. Looking at the business that we have on books, the funnel that we are looking at, some major national level events which are happening in Q2 or H2 of this year. And plus, I want to draw a perspective. Nearly 50% of Leela's business comes from international markets. And international business is still not caught up on pre-COVID levels. We are expecting going forward in H2, a lot of inbound business coming in based on the queries that we are receiving and the interest people are taking in India as a destination and Leela as a product.
International business, Anurag, is a percentage of mix. What was it earlier and what is it currently?
It's hovering between a 50% mix.
Okay, all right. And pre-COVID, you said?
Pre-COVID, it used to be nearly 65 to 70% of our mix. But we see this growing influence in India. Our products that we have created in our resorts in terms of family villas, kids play areas, reinvestments back into food and beverage and new venues and new spas. Our domestic consumption is growing. So now it's hovering around 50%. Plus, if in terms of international arrivals, if you have the statistics with you, they still haven't caught up with the pre-COVID levels. But for us, we are expecting, based on the funnel and the expressions of interest in terms of international incentives, delegations, and FITs, a strong rebound between October to February, March.
The big pull factor, the kids' play areas, I'll tell you what, I look out for them. All right. Your EBITDA target you've given of around 2,000 crores, right? By 2030. That's the aspiration. Can you hit 250 crores of PAT, say, in 27, 28? Would that be a possibility?
Hopefully, at an annualized run rate, we should be coming close to a 400 crore of PAT. But that being said, there are four major levers in which we are looking at, and I think we have already declared that yesterday in our earnings call. We see a lot of leg room and runway ahead in terms of same-store growth because of the iconic nature of our hotels, which we own, as well as the markets that we operate in. There's a huge delta between demand and luxury supply. And secondly, based in terms of the business that we see coming into India and the growing affluent base to consume luxury.
Yeah. Now, we've asked you some, long-term questions. I must ask you a very near-term question as well. If you look at average room rates, they've been trending higher, right? I think you're closer to, FY25 overall, you were just above 16,000. How much higher do you see average room rates heading, especially as we get into the busy second half of the year?
So I definitely believe that the Indian, if I give you an industry perspective, we kind of call the room rates as higher in context to what we have been historically seeing. Now, Leela has been historically growing at a high double-digit ADR over the last 5 years at a CAGR. We definitely believe we are going to maintain that momentum for a couple of reasons. I spoke earlier where our hotels are located.
Right. Anurag, we're short on time. So 18,000 rupees or so was Q1, right? For the quarter. Right. Roughly the ARRs. Where do you think H2 you'll kind of sort of maintain this? This is the flow we should work with for the rest of the year?
We are definitely going to improve this significantly in H2. This was like the first quarter, as I mentioned earlier. H2 is much stronger and much more robust in terms of inbound.
So 20,000 plus?
For sure.
So F5 26 over 25 ARR would be up how much?
We will be looking at a close to a double-digit growth in our ARR and maintain that. In the first quarter, we have grown 13% on ARR. We are likely to continue with the same trend for the full year as well.
You're adding 7 new hotels, 7 new properties, all managed?
No, actually 8 new hotels coming in our pipeline, out of which 6 are going to be owned and 2 are going to be managed. We have an active pipeline of 966 keys, and I would like to draw your attention that we are going to be coming back to Mumbai in a big way in our property in BKC. We got an iconic location in the G block in BKC, and we're going to come up with the Leela Palace, Mumbai. We already closed the transaction in this quarter, and we are getting into design development and the next steps.
Oh, wow.
Just to reconfirm that 400 crores of net profit by 2030 or 2028?
400 crores of EBITDA is an annualized run rate. 400 crores of PAT is an annualized run rate PAT that we are looking at starting from literally this quarter.
Of PAT, so there'll be 100 crores per quarter from which quarter?
Looking at starting from H2 onwards for the next 4 quarters, we're looking at 400 crores.
So FY26, 400 crores. Basically, next 4 quarters, essentially 400 crores.
Should be around 309 crores because you've done 9 crores of PAT in the first quarter, and you're saying that from year on you're going to do 100 crores of net profit.
So I tell you, the first quarter was impacted because the IPO came live on 2nd of June. So we serviced our debt and paid down our debt significantly. So first quarter is not a kind of a reflection on what the future quarters are going to be.
Yes.
But we definitely believe that us having paid down and having a very strong balance sheet, and our net debt to EBITDA is now 0.3x, which is significantly very low. So we definitely believe that having pared down our finance costs significantly, our next few quarters of PAT is going to be much higher.
100 crores per
Actually,
quarter.
Nigel, the numbers, I'm looking at this is a JP Morgan report.